Hi, my name is Omer Suleman, and I'm one of the founders of Westridge Markets, a financial technology and proprietary trading firm. I'm also one of the partners at OX1 Research, which is a London-based crypto derivatives hedge fund. To complete my background, before starting off Westridge Markets, myself and my two co-founders spent time on a number of large Wall Street banks trading derivatives and foreign exchange and commodities, and also involved with setups in high frequency technology and market making, including places like Morgan Stanley, Goldman Sachs, and Deutsche Bank. So DualX is a project that came out of these dual interests, I should say, in derivatives trading and technology development, and also from our interest in Stacks blockchain, which we've been following for a number of years, and we've been involved in a number of ways too. And in particular, when we started sort of getting a bit deeper into Clarity contracts, and we felt that this would be really something that could take the world by storm once it has its full potential. And DeFi is an area which is which has grown really large last year, and I think Stacks 2.0 and Clarity contracts could start taking a huge part of this pie, given the underlying blockchain, which is sort of the largest and the most secure in the world. So without further ado, I'm going to delve into the project and where it's coming from. So the DeFi, decentralized finance space, has this quest for yield, and this quest for yield has gotten the assets to grow from pretty much nothing beginning of last year all the way to $22 billion now. And there are a number of different lines of products in this space, like lending, automated market makers, and derivatives, and examples of those kind of products we're all aware of. But one thing to note is that lending is more than 50% of this market right now, and we think it is for a reason. And the reason is unintended risks that some of the other platforms actually present to these actors who are looking for yield. Let me just read what Genesis has published in Digital Assets Market Report Q3 last year. So it says the embedded optionality in DeFi is driving theme of hedging flow. This is hedging flow in crypto derivatives. While the majority of liquidity pool participants do not necessarily hedge their impermanent loss exposure, we believe more sophisticated market neutral yield investors are consciously considering their short gamma coming from constant product AMMs like Uniswap. And Genesis internal models estimate aggregate market short position in some of the major pools at several $1 million of gamma. So what's going on is that the AMMs are a platform where liquidity providers come in to collect yield. The liquidity takers are the guys who are generating that yield by crossing the markets and paying fees. So they do exactly as they intend to do, which is, so they have no unintended risks, just like the lenders and borrowers in the lending platforms who have no unintended risks, because effectively the lenders receive a yield, the borrowers pay a yield, but there are no other credit risk anyway because of the smart contract implementation. So in the space of automated market makers, the liquidity provider is a person who provides liquidity thinking that they will receive yield, price will go up and then down, and so they'll capture these spreads and their fees and then get their assets back. However, they put two assets into a pool, and if the asset or the price of one of these assets appreciates humongously compared to the other, they will suffer these losses, which are referred to as impermanent, but actually can be very permanent if that price move never comes back. So essentially, you can have a permanent loss in case a large price move happens, and that's something that is referred to as a short gamma position, and is referred to up here in this report, and it thinks it's several $1 million of this short gamma that the liquidity providers are holding. Now, among them are smart players, institutional players, who actually go and then hedge this gamma by being long options, and I'll come to that. But then there are also the smaller guys, the more retail guys, users of DeFi, who are not sophisticated enough and don't have any way to actually hedge against this risk. And what goes on in the derivative exchanges is that the option seller is someone who's now trying to receive yield, but because he doesn't particularly have any view, so he puts his money into a pool of funds, which then sell options, but large market moves can cause him losses. And similarly, the option buyer is someone who buys options to hedge or to speculate, but doesn't actually trade volatility, just like the sophisticated guys would. So we tend to look to solve this problem with DualX. And the solution is made up of two exchanges. One of them is DEPX, which is a deposit exchange, but actually underlying it is a derivatives exchange. And then the other is GAMX, which is effectively an automated market maker. So we're trying to solve the problem of that the automated market making liquidity provider has, which is short gamma. Combine that with the problem that the investors, the users of the derivative exchange have. So first thing is the investor. The investor comes in and he deposits funds and is looking to earn yield. He is someone who's happy to buy the underlying asset. So he's looking for a yield on his funds while he's looking to buy the asset, and can get it back in either the funds or the asset at the maturity. Then we have the volatility trader, who's also doubling as the liquidity provider. So he's the person who buys this option off him and pays him the yield. And then this optionality, this exposure that he has, which is long gamma, is then put into GAMX, which is an automated market maker, a special kind of automated market maker, which is looking to monetize the exposure that the volatility trader has, who's now doubling as a liquidity provider. The liquidity taker comes in and he trades with this AMM, pays spreads and fees, which are paid out to the volatility trader, who is just hoping that by the end of the maturity of this investor's product, the spreads and fees will be more than the yield that he has to pay, and he'll just bag the difference and pass the yield on to the investor. The GAMX will have the right amount of the funds, either in funds or in assets, and those will be returned back to the investor at the end. So now we've got a single product, which is both a options exchange and an AMM, and none of the three guys have any unintended risks. And I'll explain that in a little bit more detail here, where we can see that the derivative exchange and the automated market maker are effectively a way of moving yield from one actor to the other. And these actors have some unintended risks here. The liquidity provider has some impermanent quote unquote losses, and the option seller is exposed to large moves, while the buyer has no ability to trade his volatility. So what we do is we turn the option seller into an investor by choosing a person who's a natural asset buyer who's selling a put. So not selling a call anymore, he's only selling a put, and he's a natural buyer of the asset. So if the price goes up, he doesn't care because he sold a put. And if the price goes lower, he's fine because he wanted to buy the asset anyway. So now he's going to buy the asset and not receive his funds back, but instead receive the assets back. But the yield always comes back to him anyway. Then the liquidity taker never had a problem, and he still doesn't. The option buyer and the liquidity provider have been combined into one person, who is now basically long the option and is providing liquidity into the AMM. So she's not exposed to impermanent losses at all. And so we've got three actors here. None of them have any unintended risks attached with the original two kinds of exchanges. And we've got one product, which is a combination of an AMM and a derivatives exchange. We've got an implementation of this in Clarity Smart Contracts, which is ongoing, and that's our GitHub address that you can look at. For any comments, suggestions, and collaborations, please get in touch with me, Omer@westridgemarkets.com, and do visit our website at dualx.finance for any further details. Thank you very much.